Joining us now to talk about fixed income ETF opportunities is Colby McVey, Senior Client Portfolio Manager at Franklin Templeton Fixed Income. Well, Colby, how are recent macro developments such as shifting rate expectations or economic resilience shaping your overall outlook on corporate credit?
Yeah, thanks for having me, Jenna. Nice to be with you today. Franklin Templeton Fixed Income is a $224 billion investment manager at Franklin Templeton, led by our Chief Investment Officer, Sonal Desai. We think there's been a slowing of growth as consumer spending has weakened, but consumer balance sheets remain healthy in aggregate. Job growth has slowed over the last few months, but the unemployment rate continues to remain steady at around 4.2%. So as it relates to corporate credit, fundamentals are relatively healthy across investment grade, high yield, and bank loans. Companies have been preparing for a recession since 2022. That hasn't occurred, and we're not forecasting a recession on the horizon. Leverage and interest coverage are near historical averages. Balance sheets are in decent shape. Consumer spending supports, modest earnings growth, and maturities have been extended as capital markets have remained open over the last year. Technicals have been very strong with credit spreads nearing historic tights, attractive yields, low net new issuance, strong demand. That could change as M&A activity picks up with greater clarity on fiscal policy and trade. But ultimately, yields are still attractive relative to their 10-year averages. Investment grade around 5%, high yield and bank loans in the 7 to 8% range. So overall, we think corporate credit's in a good spot.
Colby, with credit markets offering pockets of opportunity, where are you currently finding the most compelling value across the curve and quality spectrum?
Yeah, regarding duration, we think you could see the Treasury yield curve steepen from current levels, so extending duration may not offer significant gains in portfolios. Yields in the 5 to 8% range are achievable with less than 3 years in duration, depending on the credit quality you're comfortable taking. As it relates to investment grade, we like the banking sector. We think deregulation could reduce issuance. Utility sector, that could benefit from AI-driven power needs. We're a bit cautious on anything with commodity risk. OPEC plus actions could increase supply of oil affecting prices. So for investment grade, we're a little more neutral. It's a longer duration asset class, and supply could increase if M&A really picks up, and that could pressure spreads. In high yield, we like financials. It's a really diverse issuer mix. Most don't compete on a cost of capital basis with investment grade companies. We are cautious on triple C companies. It's a very selective approach, I think, is needed here. It's hard to generalize triple C companies. So with spreads near historic tights, we don't think you need to really reach for yield. And then in bank loans, we like single B issuers, those with stable fundamentals. Yields are attractive given the risk you're taking. And like high yield, we're a little cautious on triple C loans. We think there's a heightened risk of liability management exercises. So for high yield and bank loans, we're a bit more constructive. They're shorter duration asset classes, higher yields and low default outlook, should support those asset classes going forward.
Now, Colby, actively managed fixed income ETFs have seen strong inflows. What's driving demand, and how does active management provide a potential edge in today's bond market?
Yeah, according to Morningstar, through June of 2025, fixed income ETFs have captured about 175 billion of a little over 500 billion in ETF flows. So 1/3 of the total flows to ETFs. So we've seen strong growth and adoption from investors for fixed income ETFs. When you look at what's driving demand for this, I think it goes back to the SEC passing the ETF rule in 2019. That really streamlined the approval process for active ETFs, leveled the playing field operationally with passive ETFs. And so, investors can benefit now from increased cost efficiency, tax efficiency, the transparency of holdings, and flexibility as, the ability to adjust portfolios more dynamically. I think that's all contributed to demand. Regarding the potential edge of active management, I think we're in uncertain markets, interest rate uncertainty, potential M&A and corporate actions, tariff-related impacts. Active management can offer alpha potential through security selection, sector allocation, yield curve management, whereas passive fixed income ETFs are more issuance weighted. So the largest debtors dominate the benchmark. That increases risk if those issuers face some financial problems. So I just think that active managers have more tools at their disposal to navigate potentially challenging markets.
Finally, Colby, can you walk us through how FLCO, FLBL, and FLHY are positioned to meet specific client needs in this environment and the types of investor profiles that each may be best suited for?
Yeah, FLCO is our investment grade corporate ETF. FLBL is our senior bank loan ETF, and FLHY is our high yield corporate ETF. Some of the key features across all three of these ETFs, each is actively managed, each has a track record over 7 years, and ideas are sourced by a team of 40 plus career research professionals at Franklin Templeton Fixed Income. All three of them are more benchmark aware, and that we don't take a lot of off benchmark exposure in these portfolios, but very focused on driving alpha through our highest conviction research ideas. We're not closet indexers, but are focused on delivering outcomes for clients in a no surprises approach. When I think about usage examples that come to mind, replacement for passive ETFs, we've seen institutional investors substitute historically passive exposure in ETFs for active exposure. Model allocations across RIAs, wirehouses, independents. We've seen all active ETF portfolios built out, or active versus passive, and placement where needed there. And then even perpetual or evergreen alternative funds. FLBL, for instance, has been used as a liquidity sleeve within a private credit fund, or as a cash for replacement. So a lot of uses for active ETFs. A couple parting comments, I think, just on corporate credit. Macroeconomic factors are shaping a generally positive outlook for corporate credit markets. As I said earlier, attractive yields, healthy fundamentals, strong technical support this view. However, we do expect dispersion among issuers and sectors to increase. So diligent security selection, we think, will be key to driving positive outcomes for clients in the future.
Well, Colby, really appreciate you being with us today.
Thank you for having me.
Of course, and thank you to everyone out there watching. Once again, that was Colby McVey, Senior Client Portfolio Manager at Franklin Templeton Fixed Income. And I'm your host, Jenna Dagenhart with Asset TV.